They're telling you the system is stable, and at the exact same moment, the people who run the system are stacking gold like it's the last lifeboat. Not planning to. Doing it. Right now. And 2026 isn't another holding pattern. It's the year the buying goes from calculated to frantic. Here's what's actually happening. The largest institutions on the planet have been converting paper IOUs into physical metal. Quietly. Relentlessly. And the next surge won't come from governments alone. It's coming from the retail wave, the ones who bailed in 2024 and most of 2025, about to flood back in. This isn't a chart pattern. This is a trust failure in real time. And if you're positioned in gold or silver, you need to lock in one fact. Price doesn't rise because metal is magic. Price rises when currencies get unmasked. When what looks safe starts looking breakable. Central banks don't hoard gold for fun. They hoard it because reserves are meant to survive chaos. Dollars, euros, yen, those are paper shields. For years the narrative held. The dollar is the least broken option. That story is over. The options are all broken. The building is smoking. And gold isn't an option in the building. Gold is outside the building. So what shifts in 2026? Central banks keep buying. That's guaranteed. But the real acceleration comes from the hesitant ones, the watchers, finally jumping in. Not because they suddenly believe in gold. Because they're watching the early movers win. And central banks don't follow hype. They follow survival blueprints. Here's what gets missed. This isn't an inflation story. This is a confidence story. Every reserve manager wakes up asking the same brutal question. When the system cracks, what actually holds? A treasury bond is a promise from a government drowning in its own debt. A fiat currency is a promise from a central bank that already doubled the money supply. Gold doesn't promise. Gold exists. It's what you grab when promises start sounding like fairy tales. Now the second engine kicks in. And this one can turn the move savage. Private investors. The same crowd that dumped metal when headlines went quiet. The same crowd that chased anything faster. The same crowd that got bored waiting. They've been watching from the sidelines. And they've been watching gold climb while everything else plays hot potato. So when they return, do they trickle back or do they stampede through one exit in a crowded room? Markets don't move on logic. They move on positioning. And if enough money is underweight metals going into 2026, the catch-up doesn't walk. It runs. And the run is where the real violence happens. Now let's name the number no one wants to speak. If gold doubles from here, just doubles, that puts it near $8,500 an ounce. Not prophecy. Math. But here's the venom in that math. Even if the stock market stayed flat in nominal terms, you'd be watching a collapse in real terms. Because if gold is surging that fast, gold isn't rising. The ruler is disintegrating. Your house didn't appreciate. Your currency depreciated. So when gold moves hard, it rewrites what up actually means. And that's how you get a stock market that looks fine while it hemorrhages real value. The scoreboard keeps inflating, but the metal doesn't care about your scoreboard. Now watch the next move, because this is where the narrative shatters. The world isn't rotating out of the dollar into the euro. It isn't fleeing to the yen. It isn't hiding in the pound. It's exiting the dollar into gold. And once you see that, everything clicks. Because if you're a nation holding $1 trillion in dollar reserves, you're holding pure exposure. Someone else's policy risk. Someone else's printing press. Someone else's election cycles. Someone else's debt spiral. So you rotate. Quietly. Patiently. Month after month. And when enough nations do it, the flows become structural. Money that should flow into treasuries doesn't. It flows into metal. And that changes the entire game for interest rates. Because here's the dirty truth. The system needs rates low. Debt needs rates low. Governments need rates low. But markets don't always obey. So what happens when yields spike? The central bank intervenes. They don't call it panic. They call it operations. They print. They buy. They suppress. They rebrand it as liquidity support or bill purchases or whatever label suits the headlines. But it's the same action. New money, old bonds, larger balance sheet. And every time they execute that move, they're announcing to the world, we cannot allow the price of money to be honest. This is where it turns dangerous. People will ask, but if everyone's printing, where do you run? Exactly. If you dump dollars for euros, what did you solve? Europe has its own debt catastrophe. Japan is the same disease with different symptoms. The UK has its own disaster. So the choice isn't dollar versus euro. It's paper versus metal. And metal wins when all the paper currencies start cannibalizing each other. This is why gold is becoming the settlement layer again. Not metaphorically. Literally. Some nations are already settling trade balances in gold. Not because it's elegant. Because it's neutral. It's universal. It doesn't require anyone's permission. You net out trade flows and settle the difference in a metal no one can counterfeit. That is a direct assault on dollar dominance. And when the dollar loses that function, it's not a slow fade. It's a confidence detonation. Hold this question. If the world decides gold is the final settlement instrument, what happens to everything denominated in dollars? We'll come back to that. Now let's address the question people use to rationalize staying out. Won't they just use something else? Sometimes, yes. If gold is optional, people substitute. They engineer alternatives. They cut corners. But there are applications where gold is non-negotiable, where conductivity, corrosion resistance, and reliability have no substitute. And in those cases, the buyer doesn't negotiate. They pay. That's what makes gold lethal to the paper system. Certain demand is price insensitive, and central banks understand this. They refuse to hold assets that depreciate by design. They refuse reserves that evaporate while they sleep, so they rotate into the one reserve that has no issuer. You might wonder, can we trust the countries doing this? We don't need to trust them. We need to observe them. And here's what keeps surfacing. Some nations likely hold more gold than they report. Why conceal it? Because if you're still accumulating, you don't broadcast your position. You don't bid up the price against yourself. You buy quietly. You report slowly. You keep your hand hidden. That's not conspiracy. That's strategy. Now here comes the twist that could blindside the market in 2026. Crypto, not the believers, the flows. There's a massive difference between early adopters holding keys and latecomers buying ETFs because they heard a pitch. ETF buyers are tourists. They showed up for the spectacle. They don't have decade-long conviction. They don't have deep, unrealized gains. They have expectations, and expectations shatter. If you bought a fast horse and it starts limping, you don't give it years. You switch horses. Now imagine you sold gold and silver in 2024 and 2025 to chase that faster story. Imagine watching metals surge without you. Imagine watching miners rip while your new bet stagnated. That frustration isn't emotion. It's future capital flow, and capital moves markets. So one probable setup for 2026 is rotation. Money exits the dead trade and floods back into metals that are actually performing, not because everyone converts to gold ideology, because people despise missing out more than they love being correct. There's another pressure point in crypto most ignore until it detonates. Collateral. Early holders, the ones who bought cheap, often borrowed against their holdings instead of selling. Why? Taxes, belief, ego. But borrowing only feels genius until collateral drops. When prices fall, margin calls don't negotiate. Loans get called. Collateral gets liquidated. Forced selling activates. And forced selling doesn't wait for favorable prices. It takes whatever bid exists. So you get two forces converging. Late ETF money exiting out of boredom. Leveraged holders getting forced out because the math demands it. That's not a breeze. That's a gale. And if that hits while gold and silver are pulling capital like gravity, you get a psychological stampede. Now let's bring silver into the picture, because silver is the metal that humiliates doubters. Gold moves like a supertanker. Silver moves like a motorcycle. Smaller, more volatile, more emotional. And when it runs, it doesn't jog. It explodes. A move to $100 an ounce in silver isn't fantasy. It's exactly the kind of eruption silver delivers when the market wakes up late and tries to compensate in panic. But here's the real reason silver matters. It exposes the fraud faster. Gold is central bank reserves. Silver is industrial necessity with a populist edge. When silver launches, it's the market screaming that paper pricing mechanisms are losing grip. So if we're correct about 2026, central banks accelerating, private capital returning, paper credibility fracturing, silver becomes the amplifier, the loudspeaker. One more layer. And this is where it stops being markets and becomes geopolitics. There's a scenario where a major bloc decides they're finished playing on America's game board. They don't just accumulate gold. They anchor to it. Not with rhetoric. With a peg, a defined ratio where currency units map to gold weight. That sounds radical until you remember it already existed. The dollar used to be convertible to gold. That convertibility made the dollar king. Remove convertibility and you remove the throne. Now imagine the reverse. A challenger currency offers cleaner settlement, even if only for bilateral trade. No one needs to trust the issuer the way they trust paper promises. They just need the math to clear. If that materializes, it doesn't need to replace the dollar overnight. It only needs to siphon demand, like a crack in a dam. First a trickle, then the concrete starts groaning. So where would we be wrong? Watch gold reserves. Watch trade settlement headlines. Watch Treasury auction demand. Those are the warning lights. And when they blink in unison, the everything is fine narrative collapses in real time. Let's stay disciplined. This is analysis. We manage risk. We don't gamble. We measure. So here's what matters without drowning in noise. First, central bank behavior. Not statements. Actions. If accumulation accelerates, trust is collapsing. Second, real rates and policy response. If the system needs suppression, printing continues. And printing is fuel for metals. Third, flow rotation. If capital exits treasuries into gold, that's regime change, not a trade. Fourth, crypto stress. If liquidations surge, that's forced selling feeding rotation. Fifth, silver price action. Not because we worship technicals, because silver is the polygraph. Now let me ask something that should unsettle you productively. If gold rises, but stocks stay flat in dollars, are you wealthier or did the measurement tool decay? Because that's the trap. People calculate wealth in a unit that's melting. And while they argue about index points, the informed are stacking metal. Here's the contradiction that will make 2026 loud. People will claim everything is robust while central banks behave like everything is fragile. Which signal do we trust? Remember that open question. If gold becomes final settlement again, what happens to dollar-priced everything? It means the world demands more dollars per unit of actual goods, commodities, energy, products, assets. And that is how currency crisis manifests, not as an announcement, as a grocery cart that buys less. So what's our move? We don't panic. We position. We anchor to core truths. Central banks are accumulating gold. Fiat systems depend on confidence and suppression. Private investors flip from seller to buyer rapidly. Leverage breaks hard when liquidity tightens. Interpretation. 2026 is the year the store of value debate gets resolved by action, not theory. Here's the mistake most commit. They wait for permission. They want a headline declaring, "Now is the moment." That headline arrives after the move. By the time the crowd feels safe, price is already elevated and opportunity has already shifted. So we think like professionals. If the upside case strengthens as central banks continue buying and private money returns, what's the downside? The downside is temporary calm. A few months where markets pretend. A few months where the crowd sleeps again. But even then, the metal persists. The debt persists. The printing persists. It just gets postponed. And postponement creates larger dislocations later. Drop a comment. Do you believe 2026 is when private investors finally chase gold again? And if crypto rolls over, where does that capital run first? Gold, silver, or elsewhere? Tell us below. Quick ask. If you want more breakdowns like this, subscribe. No filler, just signal. Here's the cliffhanger most aren't prepared for. If gold pushes toward the doubling scenario, it won't just be a strong year for metals. It will be a stress test for everything denominated in paper. Corporations, governments, banks, pensions. Because when the measuring stick fractures, everyone who borrowed in that unit starts panicking. So the question isn't whether gold can rise. The question is when gold rises, what breaks first? And that answer determines whether silver hits $100 the orderly way or the chaotic way. We're entering a year where the market stops debating and starts deciding. Paper claims or tangible assets, promises or metal. And the people who act first aren't acting emotionally. They're acting early. Stay alert. The next wave won't send invitations.